There is a problem with the commonly accepted logic that the stock market gives us an average rate of return of 10% a year for long-term investors. I got a DM the other day that kind of spells this out a little bit that I'd like to read to you. I'll change the name of the person that sent me the DM to protect the innocent. Let's just call them Chanel. Hi Damo, I've got a Vanguard index thing for £100 a month and I've lost 11%. Any recommendations on what I should do, or should I just persevere? I think that message is symptomatic of the problem that we're going to look to address today. I don't think it's Chanel's fault that she feels that way. It's more a mismatch between her expectations of what the stock market should do and what actually happens. So what I did, I went through 120 years of market data, looking for answers to questions, mainly, what is a normal return? And most importantly, how can we expect that return to come in each year? And the results are really surprising. And that is what we're going to talk about today. But there is an issue. I need to head from my home up north all the way down south for something that's pretty exciting. So today we're going to take this show on the road, bust out the studio. I got 4 trains to catch. I've had 2 cups of coffee and my first train is leaving shortly. I'm not wearing a watch. Let's go.
Every time I need to go, every time I need to know, bitch.
Need to turn my camera off.
Win the war, win the war, win the war, win the war.
Bye, Cobweb. Train number 1, I'm gonna score it at 5 out of 10. It's a proper northern horse and cart, you know, retired from the south 20 years ago for being unsafe and then found a new home up here. And I got my little lav mic, reminiscent of Ryan Trahan.
Good afternoon.
Before we start, I think it's important just to clarify what we mean by a return. It'll be important when we look at the data that focuses on real returns, because let's put it this way, not all returns are made equal. For example, many say that the average return of the stock market long term is between 9 and 12%, which is true, but that number's often very misleading because it doesn't take into consideration things like taxes, fees, and most importantly, inflation. That 9 to 12% that everyone quotes is called a nominal return. And while it looks great on paper, it doesn't give us the most accurate picture of how our spending power is increasing as a result of investing relative to inflation.
This inflation.
Does it really matter?
Because if the stock market goes up 9% a year and inflation does as well, then effectively you've made nothing in real terms. So when you hear me make the distinction between nominal and real returns, that's why. Investors in stocks should expect a better return than those who invest in other assets such as bonds. We take the risk, so we should be rewarded for that risk. This is referred to as the equity risk premium. It's basically just a fancy way of saying we expect stocks to return a higher amount in the long run than, say, something that's more risk-free like a bond. I mean, you would be pretty annoyed, wouldn't you, if you put your money in the stock market and your mate who had it in a bank account produced a higher return long-term than you did. Think of it as like the risk to reward profile, or another way of saying that is fortune favours the brave. I'm now in Liverpool waiting for my next train. Liverpool is famous for the Beatles, the River Mersey, and a parrot called Chanel! Not to be confused with the DM for our alter ego that started this all off. But yeah, coming back to this equity risk premium. Each year, Credit Suisse puts together a yearbook that looks at stock market returns. I've linked it below for you. Credit Suisse shows that historically they feel the equity risk premium is 4.6% and they estimate it to be around 3.5% going forwards. That's Jamie Carragher. I guess that makes him the second most famous person in this train station at the minute. Yeah, I'm just going to sit down here and hide for a second because I look super weird stood in there recording myself. So with this premium, you could expect a 3.5 to 4.2% premium for investing in stocks for taking that risk, which really doesn't sound that much, does it? But honestly, if you do the math, it's massive. If we use Chanel's example of £100 per month, and we do that for say 30 years at a rate of 10% a year, we end up with £228,000. If we remove that premium of 3.5% and calculate it, you get £111,000. Now this equity risk premium number is not what I want to focus on, as it's widely disagreed on. Estimates range between 2% to 13%. Some say it doesn't even exist. Instead, I just wanted to show that as investors in stocks, for taking on extra risk, we should expect an extra return. Otherwise, what's the point in doing it? Right, next train is here. Second train, and this is more like it, folks. I've got my own little section, the seats are nicer. I don't know why I've never sat in this bit of the train before. Train number 2 has got to be a 10 ad. Got kicked out of first class for not having a right ticket. Turns out my off-peak
Stay safe, off!
isn't good enough for the upper echelons of Avanti West Coast. This train is a 2 out of 10. But anyway, finances. That's what we do on this channel, not train reviews. So, here's some headlines for you. equities have performed best over the long run. Over the last 122 years, global equities have provided an annualized real USD return of 5.3% versus 2% for bonds and 0.7% for bills. Equities have outperformed bonds, bills, and inflation in all 35 markets since 1900. But wait a second, within the Credit Suisse document, there is a quote: "History is merely a list of surprises. It can only prepare us to be surprised yet again." Surprise, the world has gone to shit.
Summer COVID surge.
40-year high inflation rate.
Global supply chain isn't functioning.
Stand clear of the closing doors.
London, yay. Currently sat in Westminster, just waiting for my next train. Actually, interesting fact about Westminster. If you look at any lamppost, you'll see two symbols. There's a W for the Duke of Westminster, which makes sense. Then you have this little badger right here, which actually, if you look closely, is a double C, which is the logo for Coco. I won't lie to you, I went 15 minutes in the wrong direction to make that joke. The report from Credit Suisse highlights inflation as a major concern. Inflation is rampant at the moment, and inflation is bad for real returns. It eats away at any return you achieve for the stock market, and higher inflation means your investments have to perform even better just to keep up. But the report also goes on to highlight how stocks have traditionally beat inflation. So if you're sat there thinking, am I putting my money in the right place? You should be reassured by that fact. Reassured by the fact that traditionally stocks have always outpaced inflation over the long run. But it isn't just inflation we need to worry about. To combat rising inflation, governments around the world are raising interest rates. And it's this rising of interest rates that will likely cause returns short term to be poor. Over 100 years of data, Credit Suisse have shown how that in times when rates are rising, the average nominal return of US markets is only 3%, compared to 9% when they are falling. If previous periods of rising interest rates are anything to go by, investors can expect returns over the next few years to be significantly lower than previous years. So what you're saying, Damien, is expect a 3% return and that's your lot? No. I just wanted to set my stall out as to why things are going to be a bit choppy at the minute, and why that will likely continue for a while. Now that I've stomped all over your investing dreams, let's make everything better. The stock market has achieved an average rate of return of between 10 and 12% for over 100 years. And that's taking into consideration everything the world has thrown at the markets for years. And the key thing is how those returns have been distributed. While I get on my last train, let me show you. Final train ride, the train's okay. No finance chat on here, just wanted to let you know, got myself one more coffee and it's a 10 out of 10. On the right of this piece of paper, we have the return of the stock market as a percentage. The scale goes from plus 40% all the way down to minus 40%. On the bottom, I put every year from 1980 until now. This line is the average return of the stock market over that period, about 10% per year. And here are the returns for each year since 1980. The first takeaway from this data is only 1 year hit the average, right here in 1993. Just 1 year. If we expand this out and we broaden the range, so we look at years that fall 5% either side of the average, so anything from a 5% return to a 15% return, only 9 years fall in that range out of a potential of 42 years. Okay, let's look at 10% either way then. So any year with a return of 0% all the way up to 20%. 19 years fall in that range. Not even half of them are within 10% of the average. In fact, a quarter of all the year's returns, a total of 12 years, have a return that is 20% higher or lower than the average return of 10%. A quarter of all results are nowhere near the average, not even close. There is no such thing as a normal return. We invest in the markets because they have a proven track record for beating inflation and for the equity risk premium, for the understanding that shares typically outperform other asset classes. We have to accept that for that return, we are signing up for a hell of a bumpy ride. The danger of the widely quoted 10% return without any context is that people then expect a 10% return. Declines of over 20%, aka a bear market, are more frequent than years that achieve the average returns. As a long-term investor, you can expect to beat inflation, outperform other assets like bonds and cash in the bank, but you also need to expect a bumpy ride along the way. It's just how it goes. We have 120 years worth of data to show us that this is the way it is. New shirt, who dis? Now, I spent last night in a travel lodge, slept there for the night, but I think we're finally at our destination.
Hi Damien, how you doing?
How are you, Mark? You okay?
Should we talk money?
Let's do it.
Let's do it now.